So, let's pick up where we left off. Let's get into warranty. Now, what happens with warranty? So what happens here is, don't forget, the reason you offer a warranty is because it increases sales. So if you look at, so a lot of times, you know, if something has a really good warranty, you're more likely to buy it, right? A warranty, however, to the company that issues it, it's an expense. Man, that was a good Centurion voice. I should practice that, yeah? Anyway, all right, sure, I'll remember that. Okay, anyway, so here's the deal. When they sell whatever they sell, that warranty comes with it, that's an expense. And that warranty increased the sale, right? So what it is a warranty is an expense. So it's an expense. And what governs this is the matching principle. Okay? So here's how it works. So in this case, what they do is they sell a car, and let me just explain, they sell a car for $16,000. Okay? Now a smart car costs more than $16,000. I wonder if they sold for $16,000. Okay. Oh, could be. Maybe. Oh, what?
Kia Rio.
Will that do it? Okay. All right. Because, yeah, I think even that Fiat 500, which is a really cool car, I think that's closer to 20. Anyway, and then they estimate that 4% of the cost of the car will be the, it's how much is a warranty expense.
I thought usually that's about $2,000.
Well, what it is what they say is, as a general rule, that 4% of the cost of the car is what this warranty will cost us. Now, this is an estimation, right? So, for instance, I had a neighbor, and what she did is she got a used car, got a muffler and Midas, I think it's one of those, and it had a lifetime guarantee. If this muffler ever wears out, as long as you own the car, we'll replace it. Now, the average person owns a car for 2 years, so they design their mufflers to last 2 years, right? But the guarantee doesn't go with the car. She kept this thing for 10 years, and every 2 years, she'd go in and get a new muffler, right? So, anyway, the point of the matter is they estimate. So in this case, what it is they have, so now we have 16, so they have 1,600, 16,000 times 4%. That means that it's $640. So when they sell the car, and let's say they sold it on December 1st, the warranty expense is $640, and estimated warranty liability is the account. For $640, okay? Now, on January 9th of the next year, somebody comes in for some warranty, and what it is the $200 part, and all they're going to do is do the parts in this. So now when they honor the warranty, so I'll just put it up here and then we'll explain it. So the estimated warranty liability is $200, and auto parts warranty, auto parts inventory, $200. So here's what happens is, at the time of the sale, they declare the expense. It's because the warranty is part of making the sale, right? So since the warranty expense generates the sale, that's when they declare, that's when the time when they declare the warranty expense. And then it's an estimated warranty liability. So this is at the time of the sale. Then when they honor the warranty, then in this case, all they're worried about is the part. It could be, you know, labor, of course, would work a very similar fashion. And in this case, it's a $200 part, so it comes out of the liability, it comes out of the inventory. So this is what it's like when they honor it, this is what it's like when they incur it. And this is at the time of the sale. Okay? You're welcome. Now, let's get into contingent liability. Okay? Now, a contingent liability. Now, what we're talking about here is we're talking about the potential liability that can turn into a real liability given some event. So it's a potential liability that can turn into a real liability Okay, so it's a potential liability that can turn into a real liability given some event. Let me give you guys an example. When they build a dam or other things that's really dangerous, they can accurately estimate how many deaths will occur, and they know how much each death will cost them. They pay out the survivors and all that. So let me give you an example. Coal mines, fishing, all work the same way. I did a roots tour a few years back, and I went back to Locust Gap, Pennsylvania, where my mom was born. My grandfather was a coal miner, and he died close to 100. To the day he died, he had all these dark spots under his skin where he got caught in a cave-in. This coal was under his skin. They couldn't get all of it out. So anyway, he got caught in a cave-in. There was a long recuperative period, and then he went back to work the first day, came home from work, found my grandmother and the kids in a wagon. She said, "Jake, we're leaving. Are you coming with us?" They had it. So anyway, my grandfather, Jake, John, of course his name, they call him Jake, went in, and he went in the house, came back out and said, "Well, I see you took the kitchen sink. In those days, when you rented a house, you still had to supply your own kitchen sink. I guess I'll have to." So he got on the train, he got on the wagon went to the train, they went out to Denver where they had some relatives who they thought would kind of show them the ropes. The point of the matter is, there's occupations that are really dangerous, and they have to anticipate the costs. And they can accurately estimate how many people will die in a coal mine in a year, and they know how much each death is going to cost them. That's an example of it. Now, so here's how a contingent liability works. Okay, so here we have contingent liability. Okay, so it can be probable, it can be possible, or it can be remote. Okay, it can be estimatable, or it can be non-estimatable. And non-estimatable means we have no idea what it's going to cost us. Here we say we can very likely figure out what it's worth. So non-estimatable. Okay. So if it's probable and estimatable, okay, then you record as a liability. Okay, if it's a contingent, if it's probable but non-estimatable, then you disclose in a note. If it's possible, then you disclose in a note. If it's remote, no disclosure. So it has to be probable and estimatable to be a contingent liability. Now, we'll go ahead and work with this scheme of things. In reality, you won't see many contingent liabilities on balance sheets. They're a liability, you know, just because your legal department won't let you put that in print. So they'll tell you, I don't care what you call it, don't put that damn thing in your balance sheet. And so you got to do something with it, but you'll rarely see it, just because your legal department doesn't want you doing it. Okay? So, again, here's a contingent liability. If an event could be probable, possible, or remote. If it's probable and estimatable, then you record it as a liability. If it's probable but you have no idea what it's going to cost you, you disclose in a note. If it's merely possible, a note. If it's improbable, you know, like remote, there's no point in disclosing it at all. Okay? So that, all right. The ratio in this chapter is times interest earned. Now, suppose you're going to lend somebody some money. How would you estimate the likelihood you're going to get paid back? Or a better way of wording it, what's the likelihood that these people can handle the debt? Okay? So times interest earned. It equals income before interest and income taxes divided by interest expense. Okay. So what this says is here we have revenue minus expense, and then we'll add back the interest expense, we'll add back the income tax expense, we assume it's a corporation. Then this is what it is. So what it is will the additional interest be manageable, is what it's asking. So you take the interest expense, you add it back to the net income. The taxes are after the interest expense. The taxes will change because the net income will change. Then you divide that. See you next week. Okay? Then you divide that by the interest expense. What that says is, with this revenue, with this net income, can they manage this additional interest expense? Does that make sense? Sound good? All right. And you're okay with that?
Yes, because